Wow, we need to talk today. This is historic. And no, I'm not talking about hotter than expected inflation, which came out this morning. No, I'm not talking about the fact that the markets ripped higher in a very uneven way. Big tech kind of led the indexes higher. The RSP, well, did a whole lot of nothing, was up 0.16% today. No, it has nothing to do with any of that, but yes, we'll talk about it. It actually has to do with the fact that Donald Trump will ring the New York Stock Exchange bell tomorrow morning. This is a first for him. He's never done this before. And this is more important than it sounds. Because on face value, some people are going to say, well, that doesn't matter. That's not a fundamental catalyst because, yeah, fundamentals, when have they ever mattered? Okay, at least not recently. You think Apple's trading on a fundamental value that makes sense to most people? No. Do you think any of these stocks are trading on fundamental valuations that make a whole lot of sense? No. Okay, if you're bullish right now, it's not because you think you're getting a great deal on stocks. No. Okay, tangent over. Yeah, we'll keep that one short this time. Why this is such a big deal? One, it shows to markets that Trump is very focused on what the stock market does. That's number one, as kind of just a blanket rule for this, okay? Number two, it really tells me, and this is a big secret, it really tells me that I'm correct, okay? My expectation has been Trump can only do what the markets will allow him to do. If he tries to slap on a tariff that Wall Street does not like, well, he can't. Because if markets crash, well, that's a problem, okay? Trump is basically recognizing the markets and basically saying, I'm going to be the market's friend. I'm not going to do things that upset the markets, okay? This was not Trump back in his first term to some degree. He didn't want to disappoint the markets, but markets fell 20% via the Trump trade war, and nothing got done until markets were down 20% on Christmas Eve. And then he kind of backed off the whole trade war thing. I don't think Trump wants to do that this time. I think Trump wants to leave a legacy of, we all got rich. Okay. So long story short, this is very bullish for markets. And I think it's going to raise confidence that Trump is not going to be this tyrant for the markets that only cares about fair trade policies and does not care about what the markets do. Okay, that's some people's expectation. Now, you could also say the same about deportations, not just tariffs. Let's be honest. If all the illegal immigrants are deported, you're going to have a recession, maybe a depression. Okay, there's a lot of nuance there to why that would happen, but essentially imagine if you doubled the job openings, essentially in a short amount of time. That's a big problem. And each illegal immigrant, whether they are working here legally or not, they're likely paying bills. They're likely buying food and, supporting the economy, just like the average person would. So imagine taking out 15 million people that are most likely contributing to the economy in a positive way. That would be a big problem. So I think this gesture from Trump is saying, markets, don't worry. I'm not going to crash the markets. You have nothing to worry about. That's just my take from this. I think Wall Street is understanding that as well. I've seen a few clips from CNBC already today that are saying pretty much what I just said. Now, there was positive components with CPI today, and we're going to totally switch gears. Let me know what you think about the whole Trump stuff. I think overall, it's a longer term positive. It is an ode to confidence that Trump's not going to do things that massively disrupt the economy and the markets. I've known that for a while now, but it seems like Wall Street may start to actually pick up on that. Wall Street seems to be a little bit on the slow side sometimes, so it might take up some time. Now, the CPI report today was not good. Okay, so headline numbers on a month-over-month basis came in bad. Okay. 0.31% in November, holding the 12-month rate at 3.3%. The 6-month annualized rate rose to 2.9% versus 2.6% last month, and the 3-month annualized rate was 3.7% versus 3.6%. Okay, you can see here that only UBS was correct in their estimate, and they were the highest estimate. So this came in at the highest estimate, and there was only one of these, okay, at 0.31%. The median forecast was 0.27%, and some banks like Bank of America were completely off at 0.23%, okay? So this did come in well higher than most expectations, but there was some good here. CPI services, less housing, was 3.2% in November, using a 6-month annualized rate, the lowest in over a year. Nick Timmerhouse says not to be confused with PCE services excluding housing, which is quite different given how several of the PCE components come from PPI. Says here CPI shelter slowed a bit further in November, rising 0.33% after a 0.38% rise in October, a 0.22% rise in September, and a 0.52% rise in August. So that's the good part. Shelter may be starting the process of rolling over. And we see this with current market rents. They're down over 1% year over year. It's not a huge fall. You wouldn't expect to see a huge fall, but they are down year over year. So with shelter inflation up apparently 4+% year over year on your CPI report, there's a lot of room for that to come down, even down to probably 2% at some point in 2025, and that'll help bring down that overall CPI number. Now, Nick Timmerhouse writes here, falling prices or deflation of core goods over the last 18 months helped deliver a decent chunk of the disinflation we've seen. Now, or he says that has now ended, with higher car prices pushing up core goods 0.3% on the month after a 0.05% rise in October and 0.17% rise in September. So core goods was actually a pretty large source of the inflation in the last month, which I think is interesting. It will be temporary, I believe, because these Black Friday discounts, the shopping discounts overall should start to get reflected in the CPI report over the coming months. So a bit of good and bad with the CPI report, but overall, as you can see from the bond market today, bond yields are up about 5 basis points. This was an overall negative report for inflation. Now, what's actually very interesting about this, though, is what the markets are pricing in for Fed policy. So the next Fed meeting's December 18th at 6 days, 23 hours, 58 minutes away from now. There's a 98.1% chance the Fed will cut rates 25 basis points. But check this out. Yesterday, there was a 7.7% chance of no cut at all. Okay, so now today, that's a 0. But you're now at a 2% chance today of a 50 basis point rate cut from the Fed. So in spite of hotter than expected inflation, you're actually seeing the odds of a 50 basis point cut rising today, which is fascinating. And I can't exactly explain why. You can see today, just looking at the broader indexes, the Russell is up 0.82%, but let's face it, a lot of stocks in the Russell are not doing well today. The NASDAQ up 1.77%, S&P up 0.87%, and the Dow is down 0.03% today. But I will tell you, the more accurate way to kind of judge what the markets are doing is just by looking at the RSP. This is the equal weight S&P. It is up 0.15% today. So it is a mildly positive day for markets. I think most of this has to do with Trump ringing the opening bell tomorrow morning. But really what's driving the major indexes is big tech. Probably not a big surprise to most of you. Netflix is up 2.5%. Nvidia is up 3.5%. Google's up almost 5%. Microsoft up 1.5%. Amazon up 2.5%. Meta up 2.5%. Apple up 0.18%. Without this big tech rally today, you would see the markets in deep red territory. Okay, so you're getting more of that crowding into Mag 7. I think some of it has to do with the fact that Mag 7 really has not been that popular in the last couple of weeks. People have been going for this broadening out trade, and that has been working. Now you're seeing a snapback to that. Now, I don't think Mag 7 is going to lead throughout the rest of this year, but certainly today, Mag 7 is leading by a lot. And this is kind of the same old playbook that you've seen in 2023 and for the most part of 2024 when we did have stickier inflation. Before inflation really started to come down, people would just pile into big tech, and it seems like that playbook is back today. CNN's Fear and Greed Index today is neutral at 52. So even though the Nasdaq's moving up 2%, it's really not moving the needle for the Fear and Greed Index all too much. Yesterday, you were at 48, which was slightly below the midpoint. Still considered neutral. Today, you're considered neutral. And I think overall, this shows if things maybe go right, if seasonality does start to play a larger role in our markets, then there's a lot of room for markets to get some strength here. And I think that would be due to a broader market rally. I don't, again, think big tech is going to lead throughout the rest of this year, but hey, I could be wrong. Market momentum is in extreme greed. Stock price strength is fear. Stock price breadth is fear. Put and call options, extreme greed. Market volatility is neutral. Safe haven demand is fear. And junk bond demand is currently neutral. Percent of stocks currently trading above their 50-day moving average, to actually my surprise, is green today at 61.24%. You're up 0.81%. So 0.81%, less than 1% of stocks are breaking above their 50-day moving average today. Like a really strong day for markets is like 12 to 15% of stocks breaking above their 50-day moving average. So it's kind of just a little good today. It's not that good, okay? But it is positive, and that is overall a good sign, especially with hotter than expected CPI. And what I've said now on the channel for a while, especially as we head into 2025, yes, I do believe there will be a correction, a pretty aggressive correction at that in Q1 2025. But what's happening right now is we have these risk catalysts like CPI, we have the Fed December 18th, you may get other data points between now and then and throughout the rest of this year. But it's not necessarily about what the data is or how good or how bad the data is. It's about getting the risk catalyst out of the way, okay? Once you get the risk catalyst out the way, as long as it's not too bad, then just alleviating that uncertainty is good in and of itself. And that's part of what you're seeing today in the markets today, and that is part of the reason why the VIX is falling. The VIX is down about 3% today to 13.79. Also worth mentioning, you do have some earnings throughout the rest of this week. You have Adobe earnings today and after hours. That's going to be big for software, big for some of your AI adoption. Nordson and Oxford as well today and after hours. Tomorrow and after hours, you have Broadcom, again, another big one for AI, Costco, and Restoration Hardware. Tomorrow morning, you do have PPI month over month for November, expecting 0.2% for the headline month over month. That's the same as last month. And core PPI month over month is expected to actually fall to 0.2%. Last month, it was 0.3% month over month. So expecting some good news tomorrow from PPI. If we get that, that should be positive for markets. We also get initial jobless claims, expecting about 220,000. That would be a fall from last week's number of 224,000. So hopefully that goes well. If it does, as long as there's no big surprise tomorrow, then you likely get a market that continues to move higher. So let me know what you guys think about all of this information down below in the comments section. Are you bullish? Are you bearish right now? Personally, again, I'll share my opinion here. I think it's hard to be bearish on markets from now into year end. You really have to expect something is going to dramatically change. To be bearish right now, you would have to expect the Fed to be super hawkish. You would have to expect initial jobless claims are likely going to skyrocket tomorrow or something else, because the seasonals right now are very strong. And people, hedge funds, institutions, and retail investors, they want to be bullish because they believe 2025 is going to be a great year. I think expectations are probably too high, but between now and the start of 2025, I just don't see a lot to pull markets lower. Just my personal opinion. Again, I'm not a fortune teller. I'm not a financial advisor. Come to your own conclusions, all of that good stuff. So again, let me know what you guys think down below in the comment section. Have a great rest of your day, and I will see you in the next one.